Welcome to another episode of Passive with Property. Today, we have a special guest, Frank Lin, a certified financial planner and founder of Xin Wealth, which is a boutique financial planning firm. Frank specialises in tax planning, investments, superannuation, and self-managed super funds. In this episode, we'll be discussing the complexities of self-managed super funds and tapping into Frank's wealth of knowledge and expertise in financial planning. So sit back, relax, and learn from one of the best in the industry.
Welcome to the Passive with Property podcast, hosted by Dragan Domovsky. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
So welcome everybody. Today we have Frank Lin, Director, Financial Planner at TNT Wealth, which are based in Sydney. He was also a former financial planner at National Australia Bank and BT Financial Wealth. Frank, welcome to Passive with Property.
Thank you.
How are you today?
Pretty good.
Excellent. So Frank, we've obviously worked together with helping some clients within, how to use self-managed super funds. And so of course, we're going to get into that in a few minutes, but tell me a little bit about yourself and your background.
Well, that's a really long story. I can keep it short.
Yeah.
I came here from China. That was my background. So I came here for my master's degree. And when I was doing it, I was thinking, should I become an accountant, as most people would do? But just at the time, I had a friend came to me and said, look, Frank, you need to really have a look at financial services, in other aspect. And if you really wanted to help people rather than just crunching numbers. And I think, okay, I had a look and then realized there's a profession called financial advisor or financial planner. Mm-hmm. And that got me really curious. And then I started to relearn everything that I learned in uni, understanding the tax, understanding how planning works. And then slowly I stepped into financial services business and then became a paraplanner and then eventually became a planner. So yeah, it all started with my friend telling me, you need to look at other possibilities in your life. And I really enjoyed being an advisor. And I find out that I think that the core is, or the essence of this is really being there and helping people to sort out their life, and not just money, right? Money all look the same, but the stories behind money every story is different. So that's sort of really make me moving forward to understand other people's life and put them in the right direction. Mm-hmm. So with my business, like TNT Wealth, that's sort of like the business, the name. We rebranded the business to Xin Wealth in 2019. Mm-hmm. So that's sort of like to operate under the same branding with XIM Mortgage. Probably not a lot of people heard about XIM Mortgage. It is actually ranked top 15 in the country, in Australia, with mortgage settlement volume. We have thousands of clients. Wow. But for me, I'm handling the wealth side, helping people with more than just lending the money. Maybe helping them to protect their home, helping them to create wealth in other aspect other than homes, right, or properties. So yeah, this is sort of like my really brief background. Okay, I guess we can talk about more when we really get into the topic today.
Awesome. So let's dive into that, Frank. Let's talk about the managed super funds, the self-managed super funds. So what does that look like for listeners out there who are, let's just say, they're beginners in investing in a property and they say, okay, well, what can I do with my super that I have? I've got 150K in my super. What can I do? Where do I start?
Yeah, that's actually a very interesting story because I only been in Australia for about 13 years, and And just during that 13 years, I think that was 2008, so I came here, a lot have changed in the superannuation space. And I actually did a bit of research of the overall superannuation system. It only actually came into like this in the late 90s. It was previously probably just a superannuation, we call it a superannuation fund, just set up for the government employees or for university teachers. But now it's for everyone.
Yeah.
In the past, before we called a self-managed super fund, probably someone heard there was a really old name, it's called DIY super. It was a time when people think, okay, if we have the super fund to manage our money, why can't we do it ourselves? That was the first question asked when people were starting to have super. And that was a really legit question, right? So why we need to have someone to manage the money for us if we can do it ourselves? And that's sort of like where it started to, people think, okay, we need to have this thing that we can manage by ourselves. And that was called DIY super back then. Later on, people think, okay, we need to put more regulations in terms of how we really to manage the self-managed super fund. And then slowly it has transformed from called DIY super to a self-managed super. Yeah, so that was a really brief issue. But what exactly is self-managed super fund? Essentially, if we need to answer this question, we need to understand what is a trust, because self-managed super fund or any super is a special trust. Governed by the superannuation law. And that means, if we go to Australian super, it is essentially a trust established under the Australian law for all the Australian super members. But if we follow the superannuation law and establish a trust ourselves, then move the money across to our own super fund, then it is a self-managed super fund. Okay. So yeah, it's very simple and straightforward. It's just very much like having your own family trust. So it's a pool of money that putting together, but it's governed by more than just the trust law, but also the superannuation law. So what is superannuation law? People might ask, this like you're just talking about law. That's complicated words. But essentially that means, all the rules you have to follow. When you can use the money, how you can use the money, on what things you can use the money, these are the rules. So as long as you're following the rules and, you're perfectly fine, you can invest in anything. You can use the money to invest into collectibles like paintings. You can invest into racehorses if you like, and you can invest into, properties we're talking about today. And you can invest into vacant land. A lot of things that you can invest into. And a lot of people are actually experts in that special area. And they know, okay, probably we invest into this breed of horse is going to, generate 10 times or 100 times return once we sell them in 5 years' time. Yeah, so it's like it gives people possibilities of using their specialized knowledge to generate profit that cannot be normally realized with normal superannuation fund.
Fantastic, yeah. So someone comes to you and say, okay, Frank, I've got 150K. What are the steps? What do they need? What do you do for them to move forward?
Yeah, first of all, that's a really common question that we got asked. The first question is, how much do I need to have to have a self-managed super fund, right?
Okay, yeah. So what would be the minimum? What would be the minimum?
Well, it is actually it's very clear. The number is very clear. Last year, based on tax office website, it says we need to have at least $500,000 to start a self-managed super fund. So this year, so like during the Christmas time, they reviewed it and said, look, we can drop it to 200K.
Okay.
So yeah, that's the guideline. We need to have 200K to do it. But we were seeing time and time again, people with maybe $50,000 or 100K that's starting to have a self-managed super fund.
Okay.
And we're looking into why people are doing that. We realize there are a couple of we delve into the motivations. Like we look at it. One is they just don't like superannuation funds. They don't like them. They just wanted to see the money in the bank account of their own super fund. That's one thing they want to see. And second is they want to invest into things that other people can't normally invest. Like they probably want to invest into a vacant land, but it's under a trust. They just buy maybe 10% of that land which can't be normally done with other super funds. And it only probably takes about $20,000 or $30,000 to invest into it. It's a smaller investment, but it needs to be in that kind of structure. Another thing is people wanted to invest into shares, but they didn't know that there are other ways without really setting up a self-managed super fund. So if people with 150K, back to your question, came to me and said, look, I want to set up a self-managed super fund, then the first question I would normally ask is, what exactly you want to do with self-managed super fund? Often we get these answers, right? We want to invest into things that we can't normally invest with other super funds. And then obviously we need to validate if that is true. If people say, I want to invest into shares, but you can find a super fund that can allow you to invest shares without setting up a self-managed super fund. That can happen. Then is it necessary to do that? It gets down to the cost of doing it. And the second question is, they want to invest into something that is pretty exotic, but it has value, potential value to them. Then we wanted to ask is the return going to justify the cost of setting it up? So that's the second. The second question is, how much is it going to cost you to set it up? People often ask that kind of question. I think probably you're going to ask me the same question.
I probably will.
Yeah. Obviously, when people wanted to do something, right, they come to me and ask me, okay, Frank, I want to do this. And what I really wanted to understand is what's the motivation behind this, right? Why you want to do this, and how important it is for you to do it. And is the importance justifies the cost, or whatever the cost that you're putting there to achieve that kind of goal. And when you achieve the goal, is the return justifies, whatever that, you wanted to do, right? I had people came to me with $20,000 in super and said, look, I want to set up a self-managed super fund. I said, what do you want to do? I said, I want to put all my money into Tesla shares. I said, why do you want to do that? And she said to me, my husband is working as a Tesla sales, and they've been given Tesla shares, and they bought into the vision, and we want to just invest everything that we have into Tesla. When investment is not logical, it became sort of like a cult-like action, then you really can't persuade someone, because the cost is irrelevant, right? They just wanted to do it. I just want to get it done. But being a more sensible person, when we're sitting down here and talking to people, we want to understand the motivation. And the second question is the cost justifies the return? So setting up a self-managed super fund, it varies. It has a huge range, but let's talk about some basic cost. So first, to set up a trust, we need to have a trust deed. So that's sort of like a document outline who's going to benefit from it when we set it up, and all the rules governing this trust. So there's a cost involved in there. Usually there's a template, or the lawyer can draft it up for us. And it can vary from $500-$600 a copy to a couple of $1,000, depending on how complex you want this kind of document to be. But most people will choose a most flexible one, templated document to create a self-managed super fund. And when you create a trust, and you need to think about, okay, who's going to be the trustee? Myself personally, I can be a trustee, but there's a rule for it. So in Australia, if you want to have a self-managed super fund, and it's just you yourself, you can't yourself be a trustee. There's it's interesting. You can't be a trustee, because I think the logic behind it is, if something happened to you and you passed away, the one who's there to decide how the asset can be distributed is gone. Who's going to replace you? That's going to be a trouble for all the assets under the trust. So it doesn't comply with the trust law and how this can be distributed. So what happened is, if there's just one person, say, for example, a bachelor with $500,000 there, and said, look, I just wanted to set up a fund and buy everything in the fund. What we need to do is we need to set up a company, have this person as the sole director and sole member of this fund. So what happened is, if someone happened to this person, then whoever is taking the role as a director can manage the company, and the company is still there, right? So the asset still continues. So there's no impact to the operation of the trust. It's just a replacement of the director and how the director would handle the assets for that particular person. So there's a reason behind it. So we need to register the company. There's a cost for the company, and that cost from $400. There's a cost to the ASIC. There's cost around like $400. There's a cost for the accountant to do it. So online, there are platforms like, I don't know what's the name called, maybe eSuper or whatever, DIY Super, like online platforms. Everything is sort of like automated. You put in the name, they're starting to register this trust for you, the company for you. It costs about $1,000 to set up the self-managed super fund.
Okay.
So that's like the cost that is unimaginable 5-10 years ago. But now because of the technology, they made it possible. But after I spoke to a couple of clients who actually came from that kind of platform, what we realized is if you want to buy a property, you probably can't borrow as much as what you wanted to borrow. Let's say 80%. You can only borrow 60% because that's the rule governing the platform. And if you wanted to use a different lender to lend you the money, you can't. You can only use the money that is specifically signed with the platform. And obviously, they're going to take a commission or take a cut of your rate. And guess what? If you go to a normal lender, the interest rate could have been 6% for borrowing to purchase a property in a self-managed super fund. But if you go through these platforms, the interest rate can be 7% or even higher because they want to take a cut out of it. So we often think, okay, this is really cheap to get it started, but what is the ongoing cost? Nobody knows. And people with little experience of setting it up, they just think, okay, I just pay $1,000, we get everything done. But they never thought, okay, what are going to be the ongoing cost? And that's sort of where the advisors can step in to help them to sort of like understanding everything before they actually do it.
Yeah, guide them the right way.
Guide them the right way.
Yeah.
So if they really wanted to get it done properly, there are costs involved in getting the advice. So for advisors, they charge from $5,000 to $8,000, including implementing the whole thing. That could be the advice fee they're charging. And there could be another $5,000 charged by the accountant to set everything up. So in total, we're looking at somewhere between $10,000 to $20,000 for the overall initial setup cost. And the ongoing with the accountants can be somewhere between $1,000 to $2,000. So if we only have $150K in there, we're already paying $20,000. That's a pretty big amount to set it up. We only have $130,000 left in there, and that's going to significantly squeeze the possibilities of if we're going to borrow into something. So that's just the reality. When someone having that money come to me and talk to me and say that's what we wanted to do, then we have to really paint a realistic picture. But if they have $500,000 sitting there for $20,000, it is taking a really small percentage of the overall balance. Yeah. Because the fee is not going to significantly change because you have a couple of $1 million. That's right. That's the reason why ATO has set a $500,000 mark initially, and now they dropped it to $200K because they believe with the technology it is possible to significantly reduce the cost of initial setup. But still, you're going to have people get in there to really get these things done for you properly.
Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky can help. With 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. And right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code PWP along with your name and email address to 0405 105 074 now to take advantage of this offer. Don't wait. Take control of your financial future today. That number again, 0405 105 074. You're listening to the Passive with Property podcast, hosted by Dragan Domovsky. To ensure you don't miss out on valuable investing tips and information, subscribe today.
I do get questions as well from clients that they ask, okay, Frank, fantastic. Can we roll that into another property and move forward within the super? Can we build a portfolio of, say, 5, 10 properties with that one from that first purchase and keep rolling on?
Yeah, that's a really good question, because a lot of people think I might be able to build, use the traditional way, like having the appreciation, refinance, and purchase the second property. To my knowledge, I still believe I have the most up-to-date knowledge. I haven't seen any other ways around this. I have to give you a little bit of background information.
Okay.
So normally in a self-managed super fund, it is impossible to borrow money to do something. Okay. But they have a special rule, a set of rules for properties, other assets that you can purchase. But to achieve that, you have to follow this called limited recourse borrowing, that kind of set rules. Mm-hmm. What are these, what does this mean? Like, a lot of people ask me, okay, limited recourse borrowing, LRB, like they get these abbreviations, and this is so complicated. So what that really means is, if anything goes wrong, it backfires, it only, going to impact the specific property you purchase.
Yeah. So,
for example, you have $500,000 inside super, and you used 50% to purchase a property, and borrow another 50% to purchase another $500,000 property. So in total, you have a $500,000 property, another $250K shares or whatever the investment that you have it in there. Mm. What if there's a fire on the property? What if there are other damages? What if there are lawsuits that is going to charge more than what the property value is? Mm-hmm. Is it going to affect your 250K, or are you going to put your own money into the super fund to cover for the damages that's happening there? No, because of the limited recourse borrowing, the whole asset is quarantined inside your self-managed super fund. So whenever it happened, it's only going to fall back to that specific property.
Yeah,
that is in there. That is the limited recourse. So what that means is, if we purchased a $500,000 property and borrowed 50% of it, we can't really change the thing that we use as a guarantee, so sort of like the property. So we can't put a granite flat back. Mm-hmm. We can't really improve anything. We change the wooden fence to whatever the other quality is, mm-hmm. or we just maybe do we just do the gardening again. Have all the everything that put in there that previously wasn't there, like. We can have the house repainted, or have different facade put on. We can't do that. Mm-hmm. We can't physically improve the property. We can only replace what is broken. Let's say the carpet is too dirty. We can replace the carpet with another similar quality carpet.
Okay.
So there's a huge restriction in terms of how we can deal with the property. And another thing is, if we purchase the property and we borrow it, it can only be on a single title. Like if we see properties like in the city, right? You have a car park as a separate title. Yep. You have an apartment as a unit as a separate title. So if we purchase, these are two titles. And if it gets down into a self-managed super fund, it's going to be a huge problem, because you're not purchasing a single asset on a single title. You're purchasing, asset with two titles. Okay. So that's going to cause problems. And also, like people building a house and land, it has to have special wordings and rules to put in there, because you build a land and then you build a house. You go through different stages to have the project completed, right?
Yeah,
and that's going to have more, legal issues if we delve into it. So that's the reason why when we have self-managed super fund involved, we need to have lawyers as self-managed super fund lawyers to specifically look at the document and making sure that everything's done according to the law. Mm-hmm. And back to your question. If the $500,000 property went up like crazy to $1 million, like in the past 2 years, mm-hmm. can we use the extra $500,000 to borrow maybe another $500,000? Yeah, against it, and to buy another property?
Yep.
The answer is no. Straight answer, no.
Okay.
And how are we going to go about doing that? If we really want to do it, what we can do is we can sell the property, realize the capital, and then we purchase other properties.
Okay.
We can do that.
Purchase another two properties after
Purchase another two properties. Okay. Exactly.
Okay.
So the rule is, whatever is in there, you can't really top up your value, have more borrowing. So Yeah.
Sorry, Frank. So even if you wanted to pull out that equity and renovate because it's been there for 10 years and you can't do that.
You can't do that. But there are other ways you can do that. Say, for example, like we have other cash sitting in the super fund.
Yep.
We want to pay the loan off. So if the property has no loan attached to it, it doesn't need to be sitting in the quarantine room. It can go out, join all other assets because it has no other consequences with the lenders, right? So it can go out. You can actually improve the property, increase the value because there has no restrictions. You're not changing the guarantee, whatever the property as a guarantee. So you can change that. And if you want really to borrow that, you still can't do it. You're gonna have to sell it, use the money to buy other stuff. Because whenever you are borrowing, you're borrowing against the asset you purchase. And that makes sense to you, right?
Sense.
So
yeah.
So you said, look, we wanted to borrow against another two assets that are holding in a separate quarantine room. No, you can't because it has to be in the separate rooms. You can't put all of them together in your portfolio. So that really stopped a lot of people in terms of, if it is in your own name, you can refinance, top up the loan, buy another property, having a good capital growth. So with these rules in place, when we look at how property can be invested throughout the portfolio, people tend to look for more positive income generating assets. They don't worry much about the capital appreciation. But if over the long term they can have it, when they get to age 60, 65, they can still sell it without paying capital gain. Even before 60, they're paying a really low tax on that. So answer your question, it is a no. And it just took me a while to explain why we can't do it.
That's okay. Now, is there anything else that our listeners should know if they want to get into this information of self-managed super fund?
Yeah, I would say, using self-managed super fund, buying a property is a lot of people pen it very easily, and I've seen time and time again. It doesn't matter if it's real estate agents or other people with the interest in there. They say, look, this is easy. We just go ahead and buy it and everything will be okay. But when we really look at it, a good property inside self-managed super fund has certain characteristics. One thing that I mentioned earlier is it has really good cash flow for the super fund. Reason being is for a good cash flow, there are certain ways to achieve it. One is you borrow less LVR, right? If you borrow 50% or 60%, the rental income, the rent is sufficient enough to cover all the interest, right? And providing positive cash. Or the property is generating really good return. Maybe it is a house with granny flat or, multi-dwelling property that is on the same title that pumps in a lot of cash. These properties has really is not it will not become a burden to the self-managed super fund. When I say burden, that means if the fund requires another $10,000 from your salary contribution on a yearly basis, you're going to have to make sure you can provide that.
Service that. That's right.
Yeah, exactly.
So obviously we're talking about positive geared properties here. So properties that are maybe 8, 9, 10%, returns per year.
That'd be crazy. Where are you gonna get that?
No, I found a few.
Another thing.
Go please.
Yeah. Another thing is, people tend to buy two, on either side of the spectrum. Either buy this really, really old house that requires a lot of work, but it's cheap. Good cash flow.
Yep.
The problem is every year they're going to have to put in thousands and thousands of dollars for the tenants to fix this and fix that.
Yep.
And that's going to be a problem because if you continue to fix things, that's going to be extra cost that you cannot really predict or project along the way. And it could be one day that you're going to have to decide, okay, we're going to have to really replace the whole kitchen and we're going to have to redo the whole backyard and things like that. So for properties that is too old, that presents a lot of uncertainties to the overall fund's cash flow. That's another thing that people normally need to think about. The other side is people just buy off the plan. They value it too high, but the cash flow is really, really poor. And people think, okay, What about negative gearing? That's something that people often talked about when they have in the property in their own name. Negative gearing has very little value in self-managed super fund because you really can't you use that against your own personal income, right? Mm-hmm. So if the whole fund this year is negative, you have like capital depreciations and all that, you would have to accumulate along the way and then offset it by when you sell the property.
Yep.
But imagine that if you hold the property till 60, you're not going to pay a single tax on that, a single dollar for the tax. So what's the use of that depreciation along the way? So it's literally, it's not going to be that much useful. So tax-wise, it's not going to be that much useful. Mm-hmm. So somewhere like in between, good cash flow, good quality property that generates a decent amount of cash and still have a bit of capital growth. I think like a lot of people, successful people in purchasing properties, I've seen they choose these kind of properties. Yep. But what I realize is it is hard to find. If they go out on the market or just type in real estate or domain.com, well, I don't think these would be in there because a good quality, good cash flow probably be gone in a couple of days. That's In the
usually they're taken off market. Usually,
I was surprised. One of the agents actually told me, I don't know if that's the correct figure. Like at least 30% of property are settled that are not appearing on real
off
estate.
Market, I would totally agree with that. Agree with that. Yeah. And usually they're taken at a really good under market value price. So it's there's a lot of people out there, especially now. What I'm seeing in the last couple of months, and I'm sure I'll be seeing in the next 6 months, that properties will be wanting to be offloaded fast. And
they don't want to get everything tidied. They don't want to do open inspection. They don't want to do staging. They don't want to do photos. They don't want to do ads.
Exactly.
Save them maybe $10,000 for selling the property.
Exactly. Now you're going to get a lot of listeners, and I get this question myself all the time. Why would an agent sell it off market when they can make that 2% on a particular property, which is a lot of money? Well, when you're dealing with properties that are $400,000, $500,000, 2% is not that much. They would rather sell that property prior to it going on market and having the open days and open homes and advertising costs. They would rather do that and sell it off market, and it makes them look better as well for themselves and the agents, for the agents and the clients. So, for that, it's not that much of a commission.
Yeah, that makes perfect sense.
And these are the properties when we are dealing with, your $400,000 to $650,000 properties, that these are the ones that are positive or neutrally geared. Once you start going over that 700,000, of course, if it's a dual property on one title, that's a different story. But usually your one house on one title, this is the price range where you'll be looking at for them to be positive or at least neutral.
Yeah. That's right. So I guess with what you're doing or the properties that you can find for the clients, definitely the information that we in this session, in this our podcast, I guess would help them to understand what kind of property that they can look for. I had a client came to me and said, look, I want to buy a $1.2 million. They have $500,000 sitting there. I want to buy a $1.2 million property. Or should I just, maybe get a $400K and another maybe $500,000, two properties? Like, how are we going to go about doing that? Like, what should we do? Obviously, that's not where I can give advice because, I'm not a property specialist. But, when they're sitting down with the property specialist, they can discuss, okay, with $1.2 million, what kind of income we're looking at, or what kind of capital growth we're looking at. Mm-hmm. But with 400 and 600, what kind of like a location that we can choose and what kind of property we can look at. And probably they can start with something small and just to have a taste of it and see, okay, how this whole thing works. Yeah. And say, look, we just purchased the property and we don't see anything that is impacting us or the super fund or anything. And we're quite comfortable with the first one. Yeah. Then they move on to the second one and they become even more comfortable. Yeah. So I can give you a bit of figures and numbers. So with a property, if they purchase a property versus not purchasing a property, what's going to happen when they retire? In 20 years' time, so if someone is aged 45 and retire at age 65 with 20 years that in there, we just realistically give maybe 5% capital growth for the property and 3% income. That is already pretty low, very conservative figure in there.
Yeah.
Overall, it's about 8% in there. They're going to have at least 300 to $500,000 better off than not doing it.
That's right.
In a similar fashion. Yeah. If they are just purchasing a $500,000 property.
Yeah.
500K property in there. So that's gonna really make a huge difference. And another thing is when they retire, they're just getting all these kind of rent without paying any tax.
Yeah.
That is pretty crazy, to be honest. If you have 3 properties and paying you 100K a year rent, imagine how much tax you're gonna pay for it.
Yeah.
That's gonna be travel to the States, having some crazy holidays. I mean, like $20,000 that can cover a lot of things from a tax perspective, right? You don't necessarily need to be in Australia or relying on government pension. You can be anywhere.
100%. Yeah, definitely.
Anywhere.
Definitely. Fantastic, Frank. We can end it there. Thank you very much.
That's good.
Wealth of information, Frank. Thank you. And I'm sure our listeners will appreciate what you've said today. So, Frank, if anyone wants to reach out and find you, where can they look you up?
Well, the simplest and easiest way is just to type in xin.com.au in the browser or on the phone. And then you'll get to my website. Just click on Wealth and you'll be able to see my details, contact me online. It's just simply xin.com.au.
Fantastic. Thank you, Frank. And I'll also add a description with your link there they can just make it easier for them as well. So
sure.
Awesome. And we'll love to have you on in the future as well, again, and talk about other things. But
not a problem, Frank.
For today, thank you very much and talk soon.
Well, thanks for your time.
Thanks for listening to the Passive with Property podcast, hosted by Dragan Domovsky. For valuable information on property investment and wealth creation for both first-time and seasoned investors, be sure to subscribe today. The Passive with Property podcast is brought to you by the Buyers Agency Australia. Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high-growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky can help. With 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. And right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code PWP along with your name and email address to 0405 105 074 now to take advantage of this offer. Don't wait. Take control of your financial future today. That number again, 0405 105 074.